How's everyone doing? I have an impromptu webcast here. I wanted to elaborate on this thesis called Higher for Longer is Back. I want to talk about that. First off, hope you all had a good weekend. Mine was solid, enjoying the fall. I'm headed to the RWA conference in Brooklyn over the next 2 days. Scottie Pippen will be there as well. I'm really looking forward to seeing Scottie Pippen. I was a Jordan Pippen fan growing up. I always thought Pippen was highly underrated. So hopefully I can get a selfie. I've got no shame about that. I will definitely go shake the man's hand and honor the greats. So honor excellence. The world needs more heroes. He's definitely an incredible athlete. So looking forward to seeing that. So let me get into some of the ideas I'm looking at and why I think that we're going to have a risk-off environment perhaps over the course of the week, but you really got to take it day by day. And certainly the markets are, seem to be on that very quickly. I made this comment in the Lumida ledger this weekend around the housing market and mortgage rates. I pointed out that we're seeing mortgage rates go up because the 10-year is rising. And thus far, home builders have been shrugging off the mortgage rates. And I'm not sure how long that can continue. And sure enough, today we are seeing not just the housing sector, but other sectors, pull back as well, right? So you've got XHB, which is the ETF for housing, pull back. So I'm also going to cycle through a couple other sectors like financials, energy, regional banks, and the dollar, try to connect a few dots. But what happened is this: when the Fed cut rates 50 bips, they scared the bond market, and the 10-year has been going up. The 10-year is no longer adding diversification to equity portfolios. By that, I mean, it used to be the case that when risk assets dropped, like equities, you would see bonds rally. That phenomenon returned for a bit this year, but it's gone. That's actually not a good quality to see, because you want to see diversification from bonds. Otherwise, what's the point of owning bonds if inflation eats away at their return? So if I want to share my screen here again, so here you can see the 10-year is going up 2%, even as all the indices are down today. So there's no diversification benefit. What's happening is that, since the Fed cut rates right around here, markets have tightened out of concern of a resumption in inflation. And that's a legitimate concern when you see things like the producer price index is still like 3.6 percentage points ish. That's too high. It's not coming down. You still have a housing shortage, and shelter costs in real time have come down. But now with lower front end rates, you will see an increase in demand, and you could see shelter costs increase. So one of the left tail risks to watch for next year is if you get some sticky inflation. That's one of the things I've got on my themes that I'm tracking. I want to see if there's evidence that confirms or disconfirms that idea. So that's the issue, right? So the Fed cut the short end of the curve. They control the short end through open market operations. So they're buying and selling of T-bills. But the long end of the curve is driven by the market. The long end of the curve has hiked rates. Now, when it comes to economic growth, it's actually the long end of the curve that matters the most, because mortgage rates, which drive housing, are driven off the long end of the curve. Capital budgeting decisions and CapEx driven by corporates are funded off the long end of the curve. When corporates refinance their debt, or they want to do an M&A acquisition and finance with debt, it's funded off the long end of the curve. So that is actually what matters more. What about auto financing? Well, it's maybe 3 to 5 year auto loan. That's like the mid part of the curve. So, but it's not the short end part of the curve, right? So, the Fed, I've been of the view, didn't think you need to hike rates, and the market is agreeing with that view. Druckenmiller came out, he was interviewed on Bloomberg, and said, yeah, they thought that was a mistake. And the bond market vigilantes are back. That's what's happening now. Now, which firms benefit or hurt when that happens? Firms that need to finance themselves with debt get hurt if long end rates go up. So those are, and also firms that cannot access capital markets. Capital markets are doing pretty well right now. You either finance through capital markets or you finance through banks. So small caps, let's take a look at small caps. Small caps not doing too well now. I'm going to show my screen in a second. By the way, keep the questions coming in. I'll do my best to circle back towards that. So here are small caps. You can see pretty ugly day. Actually, we were short small caps as of this morning, 9:30 a.m. I put it in my Telegram group. It's open to the public. So, but we got that correct. Part of this, by the way, I think is also related to this concept of the Trump bump. If you go to Polymarket, you see Trump's odds are at peak levels. I don't think they can get any higher than where they are now. So, when everyone's all in and they're already positioned this way, it's hard for this to do better. You combine that with the fact that longer end rates are going up, then these firms don't do as well. Now, who benefits? Well, mega cap tech companies that don't need to finance with debt can do better because they can finance through their own operations. And if you look at tech stocks, they're actually doing the least worst today. NVIDIA's up a few points. There have been some price target increases there. So, tech firms are less sensitive to interest rates, those that are cash flow positive and those that are making money. So here's another thing we saw this weekend. I'm going to share my screen and look at financials. The financials really got ahead of themselves, right? It's very strong bank earnings and is way ahead of themselves now, and we're pulling back. But take a look at the regional banks. I like the regional banks. I still like these categories overall, by the way. I'm just talking about like near-term tactical ideas. Regional banks got ahead of themselves too. They're down 2.3%. We're actually short this as well right now. We sold and trimmed a number of financials and some insurance plays too, even though I think they'll do pretty well by the end of the quarter. So here's one of the things we saw this week. I'm going to share my screen. We have this chart book. It's like 300 pages, 384 pages of fun. I can't wait to teach my AI to do all the things that we do to make our lives easier. But this is, if you squint closely, this is New York Community Bank. You can see it had a red bar on Friday. These prices are outdated, by the way. This is a slide that just concatenates a couple different charts. I'm looking at the price. I'm looking at the valuation, trailing PE, looking at price relative to analyst targets, a couple different factors along the top. Look at Axos Bank. Yeah, red bar on Friday, overextended. Live Oak Bank, same thing. FMAO, regional bank, same thing. NECB, not quite, but I bet you it's a red bar today. UMBF, another regional bank, same idea. Okay. So when you see that phenomena that's pervasive, then that's a strong signal that you're probably going to have a risk-off environment in financials. So that's what we saw today. That's what we saw this morning in our caucus. What else? Taking a look at a few others here. You can just see that most of them are overextended. Not quite all of them, but quite a few. Insurance names like Lincoln, it's overextended. Okay, so higher for longer is back. That's the headline. Here's another interesting set of data points for you all. Take a look at commodities. So commodities are up. Okay, so natural gas had a correction. We'll see if that's a pause or a continuation. Too early to say, but look at oil. Oil is heading up today on this down day. So there are, some inflation concerns that Mr. Market is thinking about. Higher lows in oil. My guess is we've probably seen the bottom in oil. Hard to say, but if central banks around the world are cutting rates and the economy is stronger than people think, and China is trying to stimulate their economy, how do oil prices not go up from here? So take a look at Bitcoin. I like looking at these marginal liquidity markets like Bitcoin. Kind of same phenomena, like risk appetite really loaded up here. You see some momentum waning. So you see that in the Russell as well, as I pointed out. What about China? Right. These are like high risk, high momentum markets, right? So it's worth taking a look at what some people are doing in these markets. FXI, we had the parabola, it pulled back, pull a fake out here, now it's pulling back again. I think all these markets are saying the same thing, that you're going to see a softening in animal spirits. Things got overextended. So what is working? Well, semiconductors are working. There's NVIDIA. Well, I should say NVIDIA is working. I'd rather say that than semiconductors are working. People have realized that NVIDIA is capturing the bulk of the value in the category. Semiconductors are down, NVIDIA is up. Leadership is working. ANF is working, Abercrombie and Fitch. That's nice to see. So I think you could actually see breadth contraction. I've been on the breadth expansion thesis for several months. I actually think you could see breadth contraction because those Mag 7 names, call it Mag 4, exclude Tesla and Apple. If you look at those names, they haven't hit all-time highs, even though indices are all-time high. Look at Google. Google's up today, by the way, marginally. Okay, that has room to run, far from the all-time highs. What about Microsoft? I haven't been a big fan of Microsoft.
I found a few places near you.
You guys may know.
The first one is Microsoft. The second one is Microsoft Experience Center. The
Home
third
device
one is Microsoft.
activated on the word Microsoft. That's unusual, some kind of protest. So this is Microsoft, not at all-time highs. Indices are all-time highs last Friday. So I actually expect that we'll get a rotation back into these because I think these companies report earnings. They'll do fine. I prefer others. I'd rather overweight some names, but I actually think that this basket as a whole will do better in this higher for longer regime. Meta, one of our favorite names, pulling back after hitting an all-time high, right? That's a kind of a normal phenomenon. So I think actually the rotation back into this category makes a lot of sense. If you have a higher for longer environment or inflation does come back, then these categories are less inflation sensitive and they can continue to grow earnings. So what else? Those are the main things I wanted to share with you. Now there's some other headlines that I thought I'd comment on briefly here. One is you saw this AI startup Perplexity. They raised at a double the valuation. Okay. So chatbots, $500 million in what would be the fourth funding round in 1 year. Fourth funding round in 1 year. So AI is still hot. That's obviously you see that in public markets with NVIDIA. That's where all this money is going to get spent on, not all of it, but a substantial amount of that CapEx spending will go to NVIDIA, and then I believe it's provider CoreWeave. So here's another headline. This is really interesting. It's this lost decade idea. So Wall Street braces for a lost decade, but not yet. Now, this was driven by a view that I believe came out of the Goldman Sachs markets team. So two phenomena here. There's two interesting phenomena. One are the strategists are consistently behind where the market's going. For those that were tracking around November, December last year, Goldman had a price target of something like 4,500 for the S&P. The S&P got for end of this year. The S&P got there in a month, and they had to raise it again and again. So this is actually bullish. There's too much skepticism. People are off sides. This is looking at a bit longer term versus my kind of shorter term comments. People are overweight equities versus bonds. This is tactically negative. You can see the biggest equity allocation 4 years. That's short-term, tactically negative. And yeah, everyone's very excited, right? So that's what happens when you get to these all-time highs sometimes. So this is a chart showing the case Shiller. It's a CAPE ratio that Robert Shiller from Yale calculated, goes back quite a long time. And you can see that it does a pretty good job of showing cyclical peaks and valleys. So one of the arguments that, yeah, here you go. Yeah, it's Costin and Goldman. He's like, hey, he's bullish. He raised his price targets on the S&P for the year end. But then he says in 10 years, markets might only return 3%. It's kind of this funny, not a contradiction, but a contrast. I'm not too worried about where we finish at the year end, actually. And the reason why is so long as the primary theme of the markets, which is AI, continues, and so long as spend on those categories continue, and that we see value from that hitting consumers continue, then I think the show keeps going. That's it, because earnings will go up. The risk would be if we see a pickup in inflation. I think that's a next year problem, but it's something to keep an eye on. And if you saw a reduction in spending on NVIDIA and these other semiconductors, that would be a risk factor. So yeah, that's something to think about in terms of where we are for longer term valuations. The growth to value rotation, which I've been writing about extensively, that is still in effect. That's still happening. NVIDIA is an exception to the rule because NVIDIA is NVIDIA, and up until very recently, it was actually cheaper than a lot of other growth tech stocks. I don't mind paying NVIDIA because it's like you're hiring Scottie Pippen and Michael Jordan. You should pay them $100 million. They're gonna win championships for you. They're going to deliver earnings growth, which is what matters. So let's see what else. Some quick highlights on the newsletter here. I think solar can do pretty well. Clean energy is totally bombed out. Solar needs to play an important role. Nuclear is going to take some time. I was sharing this. This is pretty interesting. This is you can see the breakdown of OpenAI's revenue and their P&L, right? So you can see Microsoft gets 700 million of their top line revenue. That's about 17.5%. That's significant. That's a tax right off the top. Very significant royalty. That's worse than Mr. Wonderful would get on Shark Tank. And you see 3, 4, 5 billion spent on NVIDIA and the CoreWeaves of the world. That's more than their entire revenue. Okay, so who are the winners? The winners are the recipients of this spend and Microsoft. No wonder OpenAI is reportedly trying to get out of this deal by creating AGI, which would shut out Microsoft from access to OpenAI's IP. So, valuations are getting expensive in this market. We saw that with that Perplexity deal. I think OpenAI is just not a good investment. It doesn't mean that it won't make money, but it's really speculation. It's not actually investing. Healthcare stocks are, especially Medicare Advantage, were wrecked. I think this is something I'm digging into more. This is the XLV. I do think there are opportunities in healthcare, by the way. But the headline is, I think it's in medical testing diagnostics. So the basic story in healthcare is that the incentives of doctors are to prescribe tests. If a customer wants a test, the doctor gives them the test. That's one. Number two, the insurers can't override the healthcare providers. They expose themselves to liability or negative reputation risk, and that's happened. The insurer can't say, hey, doctor, no, don't give that test. So the insurers are under a lot of pressure from costs. And the other driver is that people are consuming more and more healthcare. During COVID, people got smart about utilizing the healthcare insurance. I signed up for like a acupuncture. It was a glorified back rub massage. I don't do it anymore. I'm good. But I was like, wow, my insurance gives me this benefit. How am I not taking advantage of that? I think a lot of people are doing things like that. So healthcare utilization costs have gone up. And it's not clear how insurers can do well in this environment. They need the state regulators to approve increases of cost to pass on to employers. And healthcare insurance costs are already high. That's a big burden for employers and individuals to pay. So insurers are getting squeezed. The beneficiaries of that could be pharmaceutical companies, medical device testing firms. They're the beneficiary of testing going up. So there's some really interesting names we've been looking into this weekend and the last week or so, because the whole category is trading down, even though the negative impact is really isolated to these health insurers, not some of the other players. So keep an eye on our next newsletter. We're going to share some more. We found this company that has a 90% market share in nuclear magnetic resonance imaging, the dominant market leader. We love that kind of model. If you have a dominant leader and the usage of that offering goes up, which is going to happen as you have more and more aging demographics. If you have a reasonable valuation and reasonable earnings, and you should do well. That's one of the ideas we're looking into. So What else? So did you hear about the CTO of OpenAI starting a new AI startup? You've got Ilya's got another AI startup. This is competition at the app layer. It's competition. It's search engine wars all over again. So why would I want to invest in that layer? I don't find that quite interesting. I think it's a head fake where people are chasing. It's so much easier just to buy, the CapEx receivers in public markets, and you get liquidity. I wouldn't be surprised if we look back in 10 years when we say, once again, the QQQs of the world outperformed the, private market AI deals that are just way overpriced. Take a look at this. I'll share my screen here. So Mir Murati is a co-founder of OpenAI. Another co-founder that's left OpenAI to go found a startup, raise something like $100 million. No product, no revenue. So how is this going to end? I don't think it's going to end well. The search engine wars, right? Google showed up on the scene years after Excite, Lycos, AltaVista, Yahoo. They had a better mousetrap, and it's game over. It's a dominant winner take all, and you could see something like that play out here. So anyway, keep your head above your shoulders. I do think we're going to have a risk-off dynamic. You got to pick it day by day. The faster market's correct, and the faster you're over with it. And you got to just turn the card one day at a time. Still excited about end of Q4, though. I think earnings will be fine. I think earnings will actually exceed expectations. Analysts have ratcheted down their earnings expectations, and I'm not sure why they're doing that. I see GDP growth coming in stronger than expected. I see the Citigroup Economic Surprise Index beating expectations. So people are still overly bearish. So don't, confuse my tactical point of view with where I see things landing by the end of the quarter. All right. Have a good week. Make a good one. Be well.